Aloha and welcome to Ehana Kako. We're here every week on the Think Tech Hawaii Broadcast Network. I'm Keli Akina, president of the Grassroots Institute. We're in legislative session now, and there are a couple of cliches. They're each pairs, as a matter of fact, two things that we hear all the time down at the state capitol. The first one is this: there are two things you don't want to know how they are made. The first is sausages, and the second one is legislative bills. Now that's an old cliche, but it actually amplifies another saying, and that is there are two things we can be certain about in life, and that is death and taxes. And when you put together legislation and taxes, well, you never know quite what you've got. One of the wonderful compensations of working hard to defend people's freedom and free markets, as well as a rational system of government, is that we get to know fellow warriors who are out there doing the same thing. And one whom I have admired for some time is Tom Yamachika. He's the president of Tax Foundation of Hawaii. We often find ourselves at the same hearings talking about the same bills. But I'm pleased today to welcome to our program Tom, and we're going to chat a little bit about taxes. We hope you'll learn something today about Hawaii's very powerful GE tax and sales tax that are combined, as well as we'll give you an update on some of the things going on in the legislature. Welcome to the program, Tom. So glad to have you.
Thanks for having me on the show, Kali.
Well, you're doing great work down there at the Tax Foundation. I appreciate it greatly.
Thank you so much.
And you're also at the legislature quite a bit.
Yeah, I try to be, especially when they have hearings and they want a different perspective from what the tax department may be giving them.
But you do bring a good perspective, and that is one which favors the consumer, the citizen, and in many ways you are a watchdog for tax issues for the public.
That's what we try to be, yes.
Well, at the outset, one of the forms of taxation here in Hawaii is sometimes not understood very well, and I'm wondering if you can help our viewers understand that. We call it the GET, we call it the sales tax, we call it the GET/sales tax, so there's a little confusion to it. What exactly are we talking about in this form of taxation?
Sure, what we have, the name that we give in our statutes is the general excise tax, and it's a gross receipts tax.
Okay.
What it means is that if you're a business, you get a gross receipt, then you're taxed on it. So one of the things that happens is that you as a business have several vendors as well as customers. So you get, of course, money from your customers, and then you pay your vendors. Well, your vendors are also subject to GET.
So each time there's a transaction, the GET gets paid.
That's correct. I mean, it's not.
So it's a powerful tax.
Oh, very powerful. It doesn't always get applied at the same rate. Typically, they save the highest rate, which is either the 4% on the neighbor islands or 4.5% in Honolulu for the retail transactions. But retail can also mean that the business is the end user.
Now, we often hear sales tax, but the GET is not exactly the sales tax. How do these terms fit together?
Well, it's much broader. A sales tax, as it's known in most of the states that apply sales taxes, are usually on the retail sale of tangible personal property. Okay, so if a business buys something from another business, usually no tax is imposed. If a business provides services to another business, usually no tax is imposed. We tax everything. Okay. So we tax things other than the retail sale. We tax services, we tax rent, we tax royalties, we tax interest, we tax all kinds of stuff that most sales taxes don't even touch.
And in fact, there are some things that we tax that are not taxed by most states, such as medication and food.
Food, yes. Medication, we have some exceptions, but yeah, if you buy like over-the-counter drugs from the drugstore, yeah, that would be subject to tax as well.
Okay, now let's talk about how significant the revenues from GE tax are here in the state of Hawaii. We have an annual general fund that is filled each year with taxes and other revenues for the state. About what portion of that is filled with the GET?
About half.
About half, really?
About half, yeah.
About half.
So you add together the general fund revenues from all of our different taxes, income tax, GE tax, transient accommodations, fuel, whatever have you. GET accounts for typically around half.
So that is quite an important source of revenue for the state. Now, how many people do you think know that half of the state's revenues are really coming from the GET.
No, I don't know, but
It'd be pretty small, I think.
yeah, it's very, very productive. So a lot of people say, oh, you know, your tax rate is so low. Most sales taxes are in the neighborhood of 8-9%. Why, you know, the GET is so small. You must have it really well down there. And we go, no, because it's small, but has an extremely broad base.
So there's this multiplier effect to it, in a
Right,
sense,
right.
that while we may say it's only 4 point something, what is it right now?
Well, that's another discussion entirely,
Sure.
because one of the
We have
things that
some-
we also tax is the tax itself.
Okay.
Okay.
Interesting.
So, the tax is on the seller. Okay. So if I sell you something for $100.
Uh-huh.
Okay. And let's say the nominal tax rate's 4%.
All right.
Okay. So I said, okay, I'm going to charge you tax. So you pay me $104.
All right.
Okay. So you pay me the 104, but what I have to pay is the 4% of 104.
All right. Okay.
Which is greater than 4% of the 100. Okay, so if I just do that, I lose money. So that is why people do the math and they gross up the price for the amount of tax that is being taxed as well. And that is why on the neighbor islands you are charged 4.166. Here in Oahu, you charge 4.71 or 4.712.
I see. Now, given that, it still, as you pointed out earlier, sounds smaller than sales taxes that are paid in other states. So there's a psychological component here that makes us think this is not really all that significant. But as you point out, the GET applies every single time there is a transaction, so it has a very powerful effect. This is also what we call a consumption tax, isn't it?
You could call it that, yes. But the thing to remember is that it's not only on retail consumption; it's on business-to-business consumption as well. So, for example, if if you're a software seller and I need to buy QuickBooks or some similar type of software for my business, I buy it from you. The tax is applied as well.
Okay, now here in Hawaii, there can be some inordinate impact of GE tax itself, depending upon the income level of the consumer. And isn't this what we call regressive, that this tax has a regressive nature?
Right. So there are two types of taxes that you normally talk about. One is progressive and one is regressive.
Uh-huh.
Progressive means that the tax is somehow pegged to the ability to pay of the person paying the tax.
All right.
So income taxes are normally progressive. So the more you make, the more net income that you make, the more proportionately you pay.
All right.
So the tax gets higher based on your ability to pay.
This is what we talk about with tax brackets, being in a higher tax bracket.
That's correct.
Because we're making more money, and that's progressive. So what's
Right.
a regressive tax?
A regressive tax is one that has no idea of your ability to pay. It's just applied at the transaction level. So when you buy something from me for $100, it doesn't matter if you're Bill Gates or if you're Keli Akina, the tax is still going to be the same.
So 4% on a purchase I buy, if I'm very, very wealthy, is a tiny percentage of my income, perhaps. But 4% on a purchase by somebody of very, very low income is a much higher percentage on their income.
Right.
So people at the lower end economically, you're familiar with some studies. What percentage of their income could they end up paying for GE tax here in
Well,
Hawaii?
I've seen one study that is cited by people like Appleseed Foundation a lot.
Right.
And what it says is that you look at the lower 20% of the population, you add up all state taxes as a percentage of their income, and it's around 13, 14%. You look at the same percentage for the higher end, like the top 5% perhaps, and you see how much state tax is taking as a percentage of their income, and it's more like 7%. So the effect on lower income taxpayers is much more pronounced, and that's because we in Hawaii depend so much on the GET, and it's a regressive tax.
Well, this is kind of ironic because sometimes measures in the state legislature, and you and I are going to look at some of those later on in the program, are introduced to help the poor, help the needy, and so forth. But raising the GE tax in order to fund them actually can hurt the needy and the poor.
Yeah, that's right. That's absolutely right.
And they're inordinately hurt because of the tax that we have on food and on money as well, on medicine as well.
Well, food, medicine, interest,
Mhm.
rent. Rent's a big one. Electricity, it's also on power. It's on everything.
Now, last legislative session, there was a bill to help fund the fixed rail system in Honolulu that increased, temporarily at least, our GET by 0.5%.
Well, that
Tell
was
us a
actually
little bit about that.
That was actually several years ago.
Several
that
years
was
ago.
in 2000, I think 2006. They approved our 0.5% surcharge here in Honolulu, and that goes on top of our GET. So instead of having the GET be 4% here in Honolulu, it's 4.5%. Okay. Last session, what happened is that the mayor and Hart, Dan Grabowski
Right, the Honolulu
came in,
mayor.
right, and Hart is the agency that's charged with building the rail
Right.
system, and they said, "Oh, geez, we've opened the bids for building the stations and the tracks and so forth, and we're going to need a lot more money than originally anticipated. So, may we please have an extension of the sunset date, which I think at that time was 2022, for the general excise surcharge." And ultimately, what was approved was a 5-year extension. Okay, but that's not what they originally wanted. What they originally wanted was an extension into perpetuity, right? An extension that would never end. And their justification for it is, well, we want this GE tax to subsidize the rail system because the paltry fees we charge our ridership won't be enough to operate it. And oh, by the way, tourists pay maybe a third of the GE tax, so wouldn't it be great to use this revenue source to get our operational funding?
Right. Now, I recall that you had some serious concerns about that, as did Grassroots Institute, and we were involved in hearings together, giving comments to the legislature on those concerns. Could you address just one of them briefly? You took issue with the claim made about the tourists.
Yeah, we did our own calculations on the impact of tourism spending, and we found that based on DBED data and the tax data that was published at the time, that it was more like 15 or 20%. Again, it depends on how
Right.
you draw the line. What is a tourist? I mean, we use tourist numbers.
Right.
Okay, we think that the 1/3 number comes from non-residents,
Mhm.
which could include not only tourists but people here on work temporarily or people assigned to Hawaii temporarily by the military. Things like that.
Sure. Well, I appreciate the information you brought to the legislature, and I knew they took pause based upon what you had to say. There is something very important that you did, however, that I want to talk about with you, and that is you have been part of exposing something a little bit nefarious about the collection of GE tax for the rail. We'll be back after a short break, and I'll ask you about that. My guest today is Tom Yamachika, president of the Tax Foundation of Hawaii, doing very good work in tandem with us at the Grassroots Institute, trying to keep our taxes from being absolutely exorbitant. Maybe we just have taxes that are exorbitant right now. But in any case, don't go away. You're going to learn something about what's really going on with the surcharge to increase funding for the rail. And we'll be right back after this short break.
Aloha, my name is Reg Baker, and I'm the host of Business in Hawaii with Reg Baker. Business in Hawaii is a program that talks about the positive stories in Hawaii. We're tired of hearing all the negativity. We don't want to hear about all the downside. We want to hear positive stories about business in Hawaii, and that's what Business in Hawaii is all about. We broadcast live every Thursday at 2 o'clock. Go to livestream.com for that live broadcast, and we also rebroadcast on Olelo 54 and OC 16. We look forward to seeing you on the show. Take care, and we'll see you next week. Aloha.
Aloha! How you doing? It's me, Angus McTech, wishing you to welcome and join us to see us on Hibachi Talk on Think Tech Hawaii. Join my co-hosts, Gordo the Tech Czar and Andrew the Security Guy, every Friday from 1300 to 1345. We look forward to seeing you. We'll talk tech and we'll have some wee bit of fun. And remember, let your wing gang free wherever you be. Aloha!
Welcome back again to Ehana Kako, every week on the Think Tech Hawaii Broadcast Network. I want to say thanks so much to Jay Fidel and all of the wonderful staff and volunteers who make Think Tech Hawaii work. They produce about 30 to 35 hours of original content from downtown Honolulu that is being broadcast across the world and can be accessed at any time at thinktechhawaii.com. One of the important things that we believe Think Tech is doing is bringing people together to work to make a real difference in Hawaii. And that's why at the Grassroots Institute we say Ehana Kako. Ehana Kako means let's work together, because we don't like the alternative of not working together. Let's work together to build a better economy, government, and society. And that's something that Think Tech is doing, something Grassroots is doing, and I'm pleased to say, something that the Tax Foundation of Hawaii is doing very, very good work. Okay, Tom, the big mystery now. Back when, in 2006, our legislature authorized an increase in the GET to help fund the rail, there was a provision that, or a loophole, or whatever we want to call it, that allowed something to take place that has been taking place since 2007, and that is whenever money is collected from the GET and used for the rail, 10% of it goes as some kind of service charge or fee to the state. Did I get that right?
Pretty much. So what happens is the 0.5% surcharge for rail on the GET is imposed whenever the 4% rate kicks in.
Okay.
So any retail sale, royalties, interest, rent, all of that applies, and there's a certain amount of the GET that is then squirreled away, supposedly to pay for rail. But what the law also provides is that the state is to be compensated for its services in administering, collecting the tax, which by itself is okay.
All right.
Okay, but what they said is, our compensation is going to be 10% off the top.
Okay.
Okay, and we kind of took issue with that because we took a look at what it costs to do the administration collection of this tax.
So how much does it cost?
Well, according to figures that the Department of Taxation itself provided in 2007 and 2008, maybe $1.5 million.
Okay, so $1.5 million at most per year.
Per year.
But in that given year, how much is collected to pay for that service?
$25 million.
$25 million. Now let's just punctuate that. $25 million up here is collected and taken out of the GE tax, or what is collected for the rail surcharge, and only $1.5 million is needed. So we've got $23.5 million more that's going to the state coffers that people really didn't know about.
Yeah, and the really egregious thing is that it goes straight to the general fund, okay? There is no provision whatsoever, even for the Department of Taxation, who is doing this work, to get paid a dime out of it, okay? And
So they're not even being paid for what they say it's supposed to pay for.
that's right.
It raises a question on the side, where is that $24 million to $25 million going?
And that's right. I mean, it's going to whatever programs and services are benefited by the state general fund, which could be anywhere in the state. But you think about it, you know, some or a good part of the programs and services in the state take place on the neighbor islands,
All right.
and only we in Oahu get to pay for them. So the neighbor islanders, to that extent, are having a free ride.
Okay.
And, consider that the cumulative amount of the skim over the, 7 or so years that it's been in existence is $177 million.
My goodness, you could air condition a lot of school classrooms with that. You could
Twice over, yeah.
You could house a lot of homeless people with that. You could
Definitely.
do a huge amount of good for society. So, Tom, what's happened to the $177 million?
Well, I'm sure it's been spent. On what, I don't know, but it's been spent.
Now, this is astounding because this is not something in general people in the public know about. And you've been helping to expose this. Now you're involved in a lawsuit,
Yes,
or at least the Tax Foundation. Tell us a little bit about that.
Yeah, the foundation sued the state, and we tried to expose the very fact that we just talked about. And we think it's unconstitutional, unfair, and otherwise illegal for the state to pocket all of this money, which the city and county of Honolulu raised by ordinance to fund the rail project. The more that gets taken away to do whatever, the more Mayor Caldwell and Grabowskis and whoever it is, they're going to come back to the legislature and say, hey, we need more money, extend the tax, extend the tax, extend the tax. They've gotten one extension already.
Right, and when they did come for that one extension, they were claiming that there just wasn't enough money for the rail, but as you pointed out, $170 million had been raised that didn't go to the rail.
That's right.
And so this is very, very difficult to fathom. Now, why did it happen? How is this just the way government works when we're not watching?
As far as we can determine, there was a deal that was made. Certainly, when the bill was being considered, the Department of Taxation knew that they would have to take on this additional burden, right, of collecting and remitting the surcharge, and then they said, well, we're not getting paid for it, so we got to get something, right? And then, so that's when some deal making took place, and I believe the deal that was offered was, okay, you can get your surcharge, but it's going to cost you 10%. And so, so what happened at the time? The powers that be in the city, kind of, I believe, found themselves between a rock and a hard place.
So it was a political decision, you suggest, as opposed to one where we had calculated out what the costs and benefits would be.
Well, at the time, the Department of Taxation put forth testimony saying that they thought, oh, it's going to be maybe $2.5 million in the first year and $1.5 million in every year thereafter. And that was on record. Okay, they didn't know how much the actual cost would be. Where the 10% came from, I have no idea. But that was the deal that was struck.
With respect to some other proposed legislation, there is a bill, hopefully, that will get somewhere this session, that will require the fiscal impact of any measure to be appended to an actual bill. Do you think that would have helped solve this problem had our legislators been required to actually spell out the financial impact?
I don't think so, because they're guesses anyway.
Okay.
The Department of Tax did have a revenue estimate back in 2006. They put it, they put it on record. Thank goodness for them. The legislature did what they did anyway. The Department of Taxation, we know, regularly does revenue estimates on a large number of the tax bills. They don't necessarily come forth with it in the public hearings, but sometimes they are asked the questions by legislators.
Well, Tom, you're saying, however, by being in court, that this is not simply a poor calculation on the part of the state. It's not simply that they had done guesswork and didn't calculate right. You actually used the word unconstitutional earlier. Would you explain that? In what way is this state skim of these funds unconstitutional?
Well, I don't mind if what they were charging was the actual cost to collect, or something reasonably close. But as you can see, we have a gross disparity, and there's case law saying that when that happens, it's like having an additional tax.
Right.
Okay, so you can look at it in a number of ways. Number one, it's a tax on Honolulu to fund the neighbor islands. Okay, there's problems with that. Or it's a tax on Honolulu city government. There's problems with that because governments are not supposed to tax each other. Or it's a burden on you and me and other taxpayers in Honolulu to fund things that aren't here, which implicates other provisions. And actually, when you just look at the law itself, the law is phrased in terms of costs to administer the tax. So we think what the legislature wanted in the first place, or should be getting in the first place, is their costs, period.
Well, as we look at this, your taking of the issue to court is an exercise in holding government accountable. But who do you hold accountable for such a thing? I mean, are these just anonymous offices that make these decisions? Is it the legislature itself? Who gets held accountable ultimately?
Well, we've sued the state generally,
Mm-hmm.
so we really don't care. We really don't care which office is accountable or which branch of government. We just want it to be made right.
Well, back in my debate days, we had a question that would help us focus on who to hold accountable and so forth, and it was, why do presumably good and honest men and women tolerate evil? And the answer to that question always came back, well, because presumably they're not good and honest. There are people behind these things, and so am I feeling a little bit, inappropriately outraged to think that individuals make these decisions or individuals allow this to happen and the taxpayer gets bilked?
Well, of course, individuals making the decisions, I'm sure they had the best of intentions.
Yes, well, we hope they had the best of intentions. Tom, let me thank you, though, for the suit that Tax Foundation is putting forth. And I want our viewers to understand that Tax Foundation is a nonprofit organization that depends upon the public in order to be funded. It is not funded by the government, as far as I know.
Oh, no. we actually have articles in our organizational documents that saying that we will not take a dime from government.
And there's a principle behind that. What is that principle?
Well, we don't want to be beholden to government because we're commenting on their actions.
And that's why I don't mind encouraging any of you out there, if you are looking for a good cause to support and you believe in the work that Tom is talking about, take a look at Tax Foundation's website and you can certainly become part of their work. Tom, how do people get a hold of Tax Foundation to find out more about it?
tfhawaii.org, tfhawaii.org. We're there.
Well, great, and that's been on the screen as well. When we come back from a break and go into our final session, let's talk about some of the bills that are live right now. Some of them happen to deal with the GE tax, where our legislators are proposing increases to this already very huge tax. Let's talk about those, as well as some other bills as well. How's that sound?
That sounds great.
Great. We're going to be back right after this short message, and we look forward to talking more about the tax proposals that are in the state legislature in 2016. I'm Keli Akina with the Think Tech Hawaii Broadcast Network's A Hanakako program. Don't go away. We'll be right back.
Hi, I'm Donna Blanchard. I'm the host of Center Stage here on Think Tech Hawaii. I hope that you will tune in and watch the show. It is inspiring and uplifting and educational. Also, we talk with artists of all different ilk. We talk with them about what they do, how they do it, and most importantly, most dear to my heart, why they do it. And it never ceases to be fascinating when you get the answer to that question. I hope you'll join us on Center Stage, 2 o'clock Wednesday afternoons. Aloha.
Aloha, my name is Carl Campagna. I am the host of Think Tech Hawaii's Education Movers, Shakers, and Reformers. You can see our show every Wednesday at noon at 12 p.m. on thinktechhawaii.com, as well as visiting YouTube and finding the link for the show there. The show is also aired on OC16. We look forward to seeing you on the show We have many wonderful guests, including Joan Husted, Corey Rosenlee, where we talk about the very important issues of education for our keiki. We look forward to seeing you there. Mahalo.
Welcome back to today's final segment of Ehana Kako, and as you know, my guest has been Tom Yamachika, president of the Tax Foundation of Hawaii. We want to say thank you to all of our viewers and encourage you as much as possible to make use of the content you see here week after week. You can go to the Grassroots Institute website or to the Think Tech website. Both of them are filled with interesting programs that are also informational. Right now, back to Tom. Okay, Tom, you and I are down there at the state legislature with our teams, working very hard at analyzing the current legislation. How do you feel about the number of bills that tap into the GE tax or an increase in the GE tax for their funding?
Well, actually, it's kind of surprising that there are so many increased bills that are, floating around in an election year, because you would think that it's not going to be so long before the voters who are affected by this can go down to the polls and cast their make their displeasure known.
If some of the more popular bills actually do pass, hypothetically, we could be looking at a hike up to what, the percentage level?
50%.
50% of the GET, which would take us to
Yeah,
like
because
a six.
okay, well, let me
Yes.
let me kind of itemize that for you. There is a bill that is being pushed by the teachers,
Right, we'll talk about these. Go ahead.
and that would add one percentage point onto the
Okay.
GET. So it would start from 4 to 5.
5, all right.
Okay, and then we have the existing surcharge,
Okay,
which is the
on
half
the rail.
percent.
5.5.
5.5, and then there's another one, another surcharge proposed for long-term care.
For the kupuna.
That's right. So that would be from 4 to 6, which is a 50% increase.
So that would take us up to potentially 6%, as you
Yeah,
mentioned
6% nominal rate,
there. And we could
and
go-
then and because the tax is in itself taxed, it would go from like 4.166 to 6 I think it's 6.38.
all right, so we could be close to 6.5%. And that's draconian, really, when you think about it, because it may look like only a 2% increase, but it's really a huge percentage increase when you take it all together. But let's talk a little bit about this. Oftentimes, there's ignorance about the actual impact of the bills that are proposed, and there is great sentiment for what they're proposing. For example, you mentioned the one supported by our teachers. Everybody knows that our school system is lacking in funds, and we've got everything from rooms that aren't air conditioned to supplies not being present to things teachers need and so forth. So the education omnibus bill is very popular amongst teachers and many people in the public. Because who could be against the keiki?
That's right.
But what's wrong with linking that bill to a 1% increase in the GET?
Well, again, it's where your priorities are. One of the things that you really want to be careful of is, we have people and we have businesses that are working hard to pay these taxes. You jack up the tax rate, you squeeze them, you squeeze them. Not everybody's going to survive.
Now, a good number of the teachers themselves are not at the higher end of income earning, so they might experience the regressive effect of the GET, as well as many of the families in our public school system.
Oh yeah, there's going to be a lot of pain that goes around, and like I said, some businesses may not survive; they may close down. Some people may just say, I don't want to take this anymore. They move out of state, which is what's been happening like over the past 7 or so years. An analysis was done about out-migration, and I believe they found that for Hawaii, over the past 7 years or so, was like an average of 2% per year minus, which means they're moving from Hawaii to somewhere else.
Right, and we have one of the highest rates here of new teachers actually leaving the profession and going off to the mainland for economic reasons. Now, let's take the other bill for which a GET increase is proposed, and that is for long-term care for our beloved elderly, or our kupuna. And once again, something that sentimentally pulls on the heartstrings of everybody, because we care about the keiki, we care about the kupuna. So what's wrong with increasing the GE tax?
Well,
for them, you and I are going to need this long-term care, Tom.
Yeah, well, it provides 365 days of benefit in exchange for never-ending pain. Okay? What the bill is supposed to set up is a defined benefit plan, which means that if you qualify for the benefits, you get maybe $70 a day for a 365-day period, and then it stops. Okay? And that's all you get. At the same time, all of us are paying into it, another 0.5% rate on the GET, which is what it brings in, or what it's brought in so far is like about $250 million a year in Honolulu alone now, on this island. And so extending it to neighbor islands, which this would do, would bring in a little bit more. But then, what happens with defined benefit plans? There is a couple of things. One is, in the private sector, almost nobody uses defined benefit plans anymore.
Right.
Okay, and these are for good reasons, because defined benefit plans typically become underfunded, leading to some kind of crisis. Either the employer can't pay the benefits, or they have to wind up paying a massive amount more, which is totally not what they intended in the first place. Or things can happen to the fund, like the fund can get raided, right? Which is what happened to ERS, our employees' retirement system, several years ago.
That's right.
Okay, and as a result, our employees' retirement system is actuarially underfunded by around $8 billion.
That's right.
Okay, where's the fiscal responsibility in that?
So things that seem as though they're not very big hikes can have dangerous ramifications in the long run. And so do you think, just psychologically, the fact that people are unaware of the impact of the GET, or unaware of how they're going to be impacted by any increase, makes it easy for legislators to take advantage of the public?
Or it's easy for the proponents of the measure to take advantage of the legislators.
There you go.
Yeah. Because what we're trying to impress upon them, as well as the public, is that there are long-term ramifications.
Yes.
If you put the brakes on the economic engine, or you squeeze the economic engine, more, it's not going to produce the revenue. And to the extent that it does, what's going to come out the other side? Is it going to be what you want, or is it going to be a disaster?
That's right. And this is one of the points we also make as much as we can in front of legislative committees, and that is, if you take people's money at the front end through increases in the GE tax, businesses are going to produce less. Consumers are going to consume less and spend less. And ultimately, when it comes to collecting revenues for the state, with less prosperity, the income taxes for the state are going to be less as well, which is a segue. Before we end today's program, I want to move out of GET and talk about some other forms of taxation, such as a bill right now to actually give us actually a real increase in our taxes, our income taxes, but it doesn't bill itself as such.
You mean a decrease?
Yeah, decrease.
What you're talking about is there's a bill to decrease the corporate tax. Right?
Okay,
Is that what you're talking about?
we might have time to get to that. I'm
I'm
talking
sorry.
about increasing the income tax ultimately.
Right. Okay. There is another bill that deals with income tax rates. Okay. And the genesis of that is that last year we had income tax rates going up to 11%.
Right.
And it was justified because back in 2009, lawmakers said, well, geez, our economy is in a tailspin. We're crashing in this recession. We need taxpayers to kick in, but just just for a little while.
Right,
Let's make
there
it
was
temporary.
a sunset on it.
Right.
It was supposed to end. It passed because we were told it won't go on forever.
Right, and the sunset was December 31st, 2015, so that just happened.
Right.
Okay, but there is a bill that will bring these rates back, effective January 1st, 2016, so it's like it never went away.
Well, you know, I don't hear the public up in arms over that.
Well, they might not have heard
Might
too
not
much
have
about
heard
it.
about it.
Yeah, but it's there.
Mhm.
It's moving. It's going to clear the Senate. It's going to go and be considered by the House in some form. I haven't seen the final version of the bill yet, but
Well, that sounds like it's one where it's worth it for people to get a hold of their representative and their senator. What bills are we dealing with here? What are their numbers?
I don't know the number off the top of my head, but
We'll put that on our website then.
Okay.
But this is important. And in any case, just get a hold of your representative or your senator and say, I don't want any increases in income taxes. There's another bill that has...
and let me just add.
Yes.
The increase in the income tax is not only an increase on wealthy people, it's also an increase on businesses. And the reason I say that is because between 75 and 90% of the businesses that happen in this state are not in corporate form, but they're in what we call pass-throughs, so like LLCs,
Right.
partnerships, S corporations. So the taxes are paid by individuals at individual rates.
You were talking a little earlier, we confused each other a bit over increases and decreases, because there is a bill for decreasing the corporate income tax rate.
Right.
And on the surface, based on what you say, it may not really be as beneficial as it may sound, because it would impact rather a small base of the taxpayer population.
That's correct.
Well, before we go, catch us up on what's going on with the fuel tax proposed increase.
Yeah, now there's a bill that the Department of Transportation is pushing because part of what happened at the end of last year was some key provisions of the fuel tax law sunset as well. So the tax rate on gasoline and other things rolled back. So that impacts the highway fund, which is what the Department of Transportation uses to repair our roads and bridges and stuff like that. So they need to get it back, and they go, oh well, by the way, as long as we're here, let's ask for another couple of cents. So the state component of the fuel tax was 17 cents last year. It rolled back to 16, and Department of Transportation wants to go up to 19. Okay, so this is per gallon now. So there's a couple cents more per gallon, and they want to also increase the weight tax, which is what you pay every time you register your vehicle, or every time you renew it every year, by a penny a pound. And for most vehicles, it's going to be like around $40, because most vehicles weigh around 4,000 pounds.
It's something. You know, when we add up all of these fees and all of these seemingly hidden taxes and add them to the taxes we know about very clearly, how are we doing as a state in comparison to what the average taxpayer pays compared to elsewhere in the country?
It depends on the study. I mean, different studies have been done by different organizations. The one by the National Tax Foundation is one that I found particularly reliable, and it shows us as being in like the bottom third.
Right.
Yeah, we're not at the very bottom like some studies suggest. We're nowhere near the top.
Sure. In fact, while we're not at the very bottom, as some studies suggest, we at Grassroots have looked at some of those studies and found that while they may give us some credit for having fairly low property taxes, they don't necessarily take into consideration the pervasive nature of our GET. And that is something that studies which do consider tend to use to rank us even lower. The information you gave was just excellent today. Well, Tom, thank you so very much for being on the program today. I want our viewers to know that at the Grassroots Institute, we work closely with the Tax Foundation of Hawaii and rely upon Tom and his expertise to help us to have a better understanding as we fight for a better economy and a better situation for taxpayers. Tom, thanks for all you do.
Thank you, Keli.
Aloha to you. Well, everyone, I hope you learned a lot today. It is incredible to think about the impact of our GET. As Tom pointed out, it's about half of the entire state general fund. and it's one of the most popular sources of potential greater taxation that the legislature turns to. It's important for us to be aware of this and important for us to communicate with our elected representatives what our real wishes are, and that is to have a prosperous economy that doesn't tax people beyond what they need to be. I'm Keli Akina with the Grassroots Institute, signing off until next week on Ehana Kako here on the Think Tech Hawaii Broadcast Network. Aloha.